Hello, students. This is Professor Hankinson, and this is Financial Accounting 2, Accounting 1105. This video will be going over some practice problems, which are very similar to those on your homework assignment for Learning Module 2. So we're going to go ahead and start. These practice problems are available for you to do and practice yourselves. This is great for studying for the midterm, as well as helpful for learning to see what to do to complete your homework assignment. Now, these are all the problems from Chapter 11. They're algorithm problems, which means every time you go to do these problems, the questions are going to differ. So you'll get a new problem every time you do it, which is why they're awesome and so great for practice. So let's go ahead and get started and let's launch into the first problem. All right, the first problem is talking about proceeds from a notes payable. So it says on May 15th, Franklin Company borrowed cash from Dakota Bank by issuing a 60-day note with a face amount of $92,400. For the sake of math, it says assume a 360-day year. So I'm going to go ahead and click on the answer key because I like this because it shows how they came up with the answer. So in question A, determine the proceeds of the note, assuming that the note carries an interest rate. All right, now proceeds from a note, a regular note, is going to be the face amount of the note, which is $92,400. Now in question B, it asks to determine the proceeds of the note, assuming the note is discounted. Now a discount note, they go ahead and subtract out the amount that is considered interest. So how they came up with 91,476, as you can see the math right here below. First, we will start out by taking the 60-day note and dividing it by the 360-day year. The next part, you will go ahead and take the 92,400 and multiply that by 6%. You will take the two values and multiply them by each other. And that is the amount you will, that is normally the interest amount. And since it's a discount note, you'll subtract that out. So in a discount note, remember, they take the interest out at the beginning, and the proceeds you get is the face value minus that interest rate. That's our quote unquote discount rate. So that is how they came up with answer B. Now again, a regular note, the proceeds equal the cash initially received. So in A, it was a regular note, so you pay interest on when the note matures. So you get the full face value of the note. On a discount note, they go ahead and subtract out the discount rate, and that is the proceeds you receive for the note. So let's move on to the next problem. So in the next problem, it's now going into more of a payroll side of the house, and it says federal income tax withholding. So Bob Browning's weekly gross earnings for the present week is $2,950. Browning has 3 exemptions. Using the wage bracket in the table in Exhibit 2, and you can click on that and see here it pulls it right up for you. Just wanted to show you how you can click on that hyperlink to pull up the table for you. So, so it has a using an $81 standing withholding allowance for each exemption. So Browning has 3. So the first thing you're going to do is you're going to multiply 81 times 3, which is 243, and that's going to be the withholding allowance. So it's asking you, what is Browning's federal income tax withholding? So again, I'm going to go ahead and click on show the answer key because it shows you the math and step by step on how they came up with the answer of $520.14. So again, this is his total wage. And again, I said to take the normal allowance of normal withholding allowance of $81 and multiply it by 3, which gives you a total of 243. So you're going to go ahead and subtract 243 out of his total wage earnings of $2,950. Okay, and that's going to give him an amount of $2,707. That is the amount subject to withholding, and that's the amount you're going to go and look at in the brackets. So if we go look at the brackets, he's going to fall down here in this bracket. Okay, the one below my graph, because it's $2,707. So it's going to be in this bracket. So it will be anything in excess of $1,692. All right. And that excess will be multiplied by 24% plus $276.54. So let's go back to the problem. And if we see here, anything in excess of 162, so you would immediately subtract 116.92 from 2707, multiply that 20 by 24%. When you do that, you should give, so I want to show you right here where it's broken out. I want to show you right here. So 2707 minus 1692 times 24%, and that's where they got the 243.60, and it said in the table plus 276.54. So when you add those two values together, that gives you the total federal income tax withholding. Okay, moving on to the next problem. Now this is a problem asking you to do the employee's net pay. Again, net pay equals gross pay minus deductions. So you have your gross pay minus all your deductions, and that should equal your net pay. All right, so Maxwell Washington's weekly gross earnings for the week ended April 22nd are 1302. And his federal income tax withholding is 234.36. Assuming that Social Security rate is 6% and Medicare is 1.5% of all earnings, what is Maxwell's net pay? So immediately what you're going to do is going to do some multiplication. So let's go ahead and click on that answer key. So we know his gross pay is 1302. All right. And that his federal income tax withholding is 234.16. They gave us that. So how we come up with the Social Security and Medicare is simple. You multiply his gross earnings by 6% for Social Security, and then you multiply his gross earnings by 1.5% for his Medicare tax. Add up all of these deductions, and that should equal 332.01. And you'll subtract that from his gross earnings of 1302. So his net pay should equal 969.99. And of course, when we're talking about dollar value, you are going to always round to the nearest 2 decimal points. Feel free to pause this video to study the solutions so that when you're working the problems in your homework, you can pause the video and see how the calculation and the math was done. So let's moving on to the next one. Now we're going to be journalizing some payroll entries. So let's go ahead and open up each tab so we can look at everything all at once. So the payroll register for Clapton Company indicates a $14,280 of Social Security withheld, $3,570 of Medicare tax withheld on total salaries of $238,000 for the period. Federal withholding for the period totaled $43,500. Now it says on December 31st, provide the journal entry for the period's payroll. Refer to the chart of accounts for exact wording on the account titles. Okay, so here's our chart of accounts. Again, you can use my my quick trick of highlighting and then copying and pasting the wording for the chart of accounts, because it does make it much easier. So it wants us to journalize the period's payroll. Okay, so let's go ahead and just click on that answer key and let's just look at how they did it. So they gave us in the problem the total salaries. Total salaries equal 238,000. So that's going to be your salary expense. So you're going to come over here to your expense accounts and you're going to find salaries expense, and you're going to copy and paste that down in here. Okay, and next thing they gave us so let's go ahead and just get that going. So show you an example of what I'm talking about when I say copy and paste. We got our date put in there, so you can just copy. So if you see what I did, oh, there, sorry. So you can either use the copy and paste function of Control C and Control V, or you can right click it in there. I just want to show you both examples of how you can do that. So our total salaries, if you go back up the top of the payroll, our total salaries for the period was 238,000. So we're going to start out with our debit, and our debit's going to be to an expense account, because if we remember, expenses are always recorded with a debit, and we always start our journal entries with our debit entries. So I'm going to turn 238,000. So if you see there, I didn't even have to key in the comma. I don't have to key in any decimals. It does it for you. Okay. So next thing we're going to do is we're going to start recording the Social Security, Medicare, and the federal withholding. Now, these are all withholdings. So if you remember correctly, we first set these up with a payable when we are recording the payroll, okay? Not processing payment for payroll, but recording the payroll. So we're going to go ahead and set up all the payables. Now, again, what is a payable? Payables are liability. So we're going to come over here to our liabilities, and this is where we're going to find the accounts we're going to be using for our credits. Okay, so the first thing we're going to do is we're going to do our go ahead and start with our Social Security, and I'm just doing the Control C and the Control V functions, but you can, as I showed you earlier, you can definitely right click. So 14,280 was withheld for Social Security. All right, then we'll come back up here. The next one is the Medicare tax withheld, which was 3,570. So let's come down here and we'll find the Medicare tax payable account. Copy, paste, 3,570. And then the last one it gave us was federal withholding. So let's go and look for the federal. Here we go, the employees' federal income tax payable. And go ahead and copy and paste that in. And that amount was 43,500. Now, okay, so the amount that it did not give us is our last payable. And if you go back and look in your books, the last payable is going to be salaries payable, which should equal to the net pay that we're going to actually pay each of our employees, because this salary expense represents the total gross salaries. Okay, each of these payables right here represents the withholdings that we're going to withhold from their paycheck. So the very last payable we're going to set up is their salaries payable, which again should be equal to the net pay that we're going to pay each employee in their paychecks. So here we will have to do a little bit of math, because all of our debits and all of our credits have to balance. And right now we do have more debit than we have credits. So we're going to first start out by taking the gross pay, which equals the salaries expenses. That's their gross pay. And we're going to subtract out all other withholding. So we'll subtract out the Social Security withholding. We will subtract out the Medicare tax withholding, and we'll subtract out the federal income tax withholding. Okay, so if we did our math right, there we go. So again, this is the solution showing that they match. So what I entered was correct because it matches the solution. And I just kind of want to go make sure to double check that. So again, when you are recording the period's payroll, and this is what we're doing, we're journalizing that pay period's payroll. You always start out with salary expense. Salary expense is going to be equal to the gross pay of all your employees. Then you're going to record the Social Security, Medicare, and income tax withheld from your employees' paychecks. And the last payable you set up is going to be the salaries payable, which should equal to the net pay that you're going to pay your employees. When payroll is processed and the payments go out, then all of these payables will be offset with a debit entry, and your subsequent credit entry will be to cash, because you'll be either processing direct deposits or you'll be processing paper checks, depending on your company's payroll process. All right, so let's move on to the next problem. And again, feel free to pause this video at any time and study the solutions and how the solutions came up, how I came up with the solutions. Excuse me. So let's go on to the next problem. All right, this is going to be now journalizing payroll tax. So journalizing payroll pay period, that was the employees portion of it. Okay, because we do withhold from the employee's paycheck and pay Social Security, Medicare, and income tax on behalf of the employee. But you, the employer, also have expenses you have to record on your books, and these are called the payroll taxes. So let's go ahead and look at this problem. So the payroll register indicates a $14,280 Social Security withheld and a $3,570 of Medicare tax withheld on total salaries of $238. Now, if you remember, this is almost identical to the problem we just did. So if you remember back into your books, part of the employer's payroll taxes is they're required to match the Social Security and Medicare withheld from their employees' paychecks. The employer is required to match that. So that's why that information is given again. We're going to record that as an expense on our books. Now, it also tells us that earnings of $30,000 are subject to the state and federal unemployment compensation taxes at the federal rate of 0.6% and the state rate of 5.4%. So immediately what we're going to do is we're going to start journalizing some entries. So we're going to go ahead and put in our date. Now, I told you guys, we always start with our debit entry. Our debit entry is going to be an expense account, and it is going to be our payroll tax expense account, because we're recording the employer's portion of payroll taxes that they're required to pay. So we'll start out with that. Now, we don't know the amount of this expense yet, because we have to do some calculations. So just for the sake of time, we do know two of them. That is the Social Security and the Medicare, because again, we as the employer match whatever we withheld from the employee. So let's go ahead and get those payables entered. So we'll do the Social Security payable of $14,280. And we will go ahead and do the Medicare tax of $3,570. All right, so then what we have to now do is we have the federal and state unemployment tax payable that we have to set up. So the federal unemployment tax payable is going to be 0.6% of $30,000, because up here it said earnings of $30,000 is subject to the federal unemployment compensation taxes. So we're going to start by multiplying out the federal, so 30,000 times 0.6% equals $180. And then the state unemployment tax payable, we'll copy and paste that on in. And that is 5.4% of $30,000. So we'll go ahead and do that math. And that is $1,620. Now, really quickly, we'll check our work, but we need to add up all of our credits so we'll know what our total payroll tax expense is going to be. So we're going to take the 14,280 plus the 3,570, 1,620, and 180, and that equals 19,650. So if we did our math right, everything is correct. So really quickly, looking at the problem again, Social Security and Medicare, we matched from what we withheld from our employees. And then the state and federal unemployment tax, they tell us is going to be multiplied against the earnings that are subject to the federal unemployment compensation. Now, again, determining what amount is subject to the unemployment tax, that is a different calculation that's not going to be covered in this chapter. So that information is always going to be provided to you, but only certain salaries are eligible for unemployment. So only the salaries that are eligible for unemployment are the salaries that are subject to the compensation taxes. So how that is determined, again, is not covered in this chapter. So, but let's look back down here. So once we calculated all of the payables that we're going to pay as our portion of the payroll taxes, we're able to add up all those credits to know exactly how much is going to be our payroll tax expense. And we can go ahead and record that as our debit. So let's move on to the next problem. Now we're talking about vacation pay and pension benefits. So let's take a look at this problem. So this company provides its employees with vacation benefits and a defined contribution pension plan. Employees earned vacation pay of $17,500 for the period. The pension plan requires a contribution to the plan administrator equal to 6% of employee salaries. Salaries were $230,000 during the period, and the full amount due was contributed to the pension plan administrator. So we're going to go ahead and show the answer keying and come down here. So we're going to go ahead and journalize the vacation. And it tells us that the employees earned vacation pay of $17,500 for the period. Okay. So we set up the payable and go ahead and record the expense. And we do that at the end of the year. Because as employees use their vacation, we will debit the payable and credit salaries payable. Okay. Now to record the pension contribution, basically that would be 6% of the 230,000. And so that journal entry, you would also record as a pension expense, but this time you're paying it, so you're going to offset it with a credit to cash. All right, so that is the journal entry for the defined contribution plan. So 6% of the salaries, and we paid the full amount. So we go ahead and record the expense under pension expense, and we record the payment as credit to cash. All right, so we talked about contingency liabilities. We talked about if they're probable, possible, or remote. So this is an example of one of those contingency liabilities that are definitely probable and it is measurable. So if it's probable and it's measurable, then we do record it as a journal entry. So the example given here is an estimated warranty liability. So it says Fitzpatrick Company sold $280 of equipment during January under a 1-year warranty. Cost to repair defects under the warranty is estimated at 5% of the sales tax. On August 15th, a customer required a $95 replacement plus $48 of labor under the warranty. It says provide the journal entry for the estimated warranty expense and also the August 15th warranty work. Okay, so let's go ahead and go down here and look at how they entered the entry. Now on A, they wanted you to go ahead and provide a journal entry for the estimated warranty expense. So it said it was 5% of the total sales price. So if we come up here, we'll take 5% of $280,000. And that equals $14,000. So right here, it has it broken down for you. You can see the math. So you start out by recording the expense and then offsetting it by setting up a warranty payable. Okay. So then they wanted you to journalize the warranty work on August 15th. So we'll go ahead and click over to the next tab. So according to this information above, the customer required a $95 part replacement plus $48 of labor under the warranty. So how would we record that? So we offset the payable we set up when we did the warranty expense. So we go ahead and do a debit to that payable, reducing the payable balance because we are actually doing some repairs against it. And then you're going to reduce your supplies, which is supplies again as an asset. We can see over here because you're taking parts out of your supplies. So you're going to have to reduce your supply balance. And then you go ahead and record the labor under wages payable, which will be offset as part of the net pay that you will pay your employees, excuse me. So, and how you determine how much you offset the payable would be the value of the supplies and the labor. Okay, so now we're going to be looking at a quick ratio. And again, quick ratio is a look at your current assets and your current liabilities. So I don't have a whiteboard to show you how to do the math. So let's just go ahead and click on the answer key because it has the math broken out for you and you can see it. Now, again, quick ratio is different from your current ratio. Quick ratio wants to look at just quick assets. Quick assets is going to be your cash, any temporary investments you have, and your accounts receivable. So that's going to be your quick assets. And you will take your total quick assets and divide it by your current liabilities. Okay, and here your current liabilities is just your accounts payable. So if you see here, they went ahead and for your current year, it shows that they took the cash, investments, and account receivable, added them together, and then divided it by your accounts payable. And that gave you a quick ratio of 1.6 for current year. And did the same thing for previous year. They took your cash, investments, and receivables, added those together and divided it by your accounts payable. You can see the math broken down right here for you. So previous year, your quick ratio is 1.8. So comparing previous year to current year, is a quick ratio improving or declining? It would be declining because you want the higher the number, the better. Because this means you have, in previous year, you've had enough quick assets to pay off your current liabilities 1.8 times. Whereas in current year, you only have enough quick assets to pay off your current liabilities 1.6 times. Okay, so that does it for Learning Module 2 practice problems. So again, these are practice problems to help you hopefully solve some of your homework problems for Learning Module 2. It's also a great study tool for preparing for the midterm. If you have any questions or concerns regarding any of these problems, feel free to email me, and I can help you work out any of the solutions. So thank you, and good luck.